Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 20th of August, 2020. And yesterday we published a video entitled Gold and Silver Dip Ahead of FOMC Minutes, where we reported that although gold had peaked at $2,015 earlier this week and silver at $28.48, they had fallen back to $19.70, that's $1,970, and $27.40 respectively, prior to the FOMC Minutes announcement. Now, we suggested both may have further to fall prior to the announcement, as it was produced a couple hours before, and then depending what was in the minutes would dictate what would happen to prices thereafter. Well, prices did fall, and then they continued to fall after the announcement, with gold actually falling as low as $1,925, but has recovered a little and currently stands, as at 14:42 GMT plus 1, at $1,933, just $8 higher than its low. Silver too fell back, only though to $26.56, and again has recovered a little to its current price of $26.93. Now, some of that recovery may be partially down to the weekly jobless claims rising this week to 1.11 million from last week's 971,000, which suggests a reversal in the improving jobs market. The dollar too has also strengthened a little today. The question, of course, on everyone's lips is, can the dollar prevent what some may deem as its continuing inevitable fall? And if those people are right, this will prove extremely bullish for gold and silver if that fall cannot be stemmed. And if they are wrong, may indeed act as headwinds for the precious metals. We shall now take a look at two articles, one published by Bloomberg and the other by Reuters, both today, suggesting what is happening to the US dollar, what they forecast is going to happen to the US dollar, and what they have gleaned from the FOMC minutes. So let's take a brief look at those two articles. Bloomberg Article, dated August 20th, 2020. Headline: Time runs out for dollar bulls. Is this time different? The clock is ticking on the dollar's long-enduring bull cycle. After 9 years of strength, the currency is being assailed from all sides. This year, the Federal Reserve joined other central banks in slashing interest rates to rock-bottom levels, wiping out the dollar's advantage vis-à-vis the euro and yen. Ballooning debt and deficits have eroded foreign investment in the United States, and trade-weighted measures suggest the dollar's decline is overdue. For the doomsayers, they finally herald the beginning of the end. It's reminiscent of previous turning points in 1985 and 2002, when abrupt policy shifts upended the dollar and ushered in protracted periods of weakness. Now, a bleaker growth outlook in the US compared with Europe could hasten the reversal. It's little wonder the greenback has slumped to a 2-year low following its worst month in a decade, and traders on a net basis are shorting it for the first time in years. The dollar has been overvalued for a long time, and this might finally be a catalyst for a multi-year downtrend, said Brandywine Global Investment Management's Jack McIntyre. As we've seen before, when valuations have been stretched, a policy or economic shock can quickly change the currency's trajectory, and that's what seems to be happening thanks to the Fed's swelling balance sheet, a surge in debt, and the way we handled the pandemic. Granted, die-hard bears have been sounding alarms about the dollar's imminent demise for years now, only to be wrong time and again. Whether it's inflation, America's twin deficits, or the Fed's easy money policies, fears over dollar debasement have done little to diminish its standing in the real world. The currency still accounts for more than 60% of global reserves and is the most widely used for international transactions by far. What's more, the end of the bull run doesn't necessarily mean the end of the dollar, according to BNY Mellon Investment Management's Liz Young. There's a difference between there being a pullback in the dollar and there being a complete collapse, she said. This is a pullback. It's a little extreme to think the dollar is going to lose its reserve status anytime soon. Nevertheless, a chorus of prognosticators, including Goldman Sachs, says this time is different, and the greenback's reckoning has been a long time coming. Climbing 30% from its nadir 12 years ago, it has been the most overvalued major currency based on real effective exchange rates, which take into account countries' relative trade balances, since 2014, according to the Bank of International Settlements. The dollar is also around 16% stronger versus the euro, based on OECD's purchasing power parity data. History suggests that once triggered, dollar strength could quickly unravel. Plaza Accord. The first bull cycle occurred between 1980 and 1985, when the greenback almost doubled in value. But once the world's richest nations signed the Plaza Accord to depreciate the dollar and help the US pull out of its recession, the dollar soon lost all of that and more. The second cycle began around 1995 and lasted 7 years before ending amid speculation President George W. Bush wanted a weaker currency to boost exports and manufacturing. The greenback went on to slump 33% in the following 2 years. Dollar cycles are long and persistent, and we are now at the top end of valuations, said Guillermo Felices, head of research and strategy at BNP Paribas Asset Management's multi-asset group. He predicts a dollar retreat over several years. Ultimately, relative monetary policy is a key driver. The Fed continues to be the most aggressive and proactive central bank when it comes to policy stimulus, and that is likely to continue to be the case. The Fed is committed to keeping rates close to zero for years to come, as central banks officials try to mitigate the economic fallout from the pandemic. But its efforts have been hamstrung by the US's failure to get a grip on the virus, even as countries in Europe and Asia have been more successful in containing its spread. That's weighing on the outlook for US growth, which has pushed down long-term government bond yields closer towards the rest of the world and raised expectations for more deficit-inflating stimulus. In a more dire signal for the dollar, inflation-adjusted real yields are now negative, reaching record lows in July. Wall Street heavyweights, including Jeffrey Gundlach and Ray Dalio, are among those taking notice. Gundlach said earlier this year his strongest market conviction is a weakening dollar on the back of rising US government and trade deficits and a pullback in foreign investment. Dalio sees US-China tensions resulting in a capital war that will lead to the currency's decline. Throw in doubts about the US election and the federal government's haphazard response to the coronavirus, and you've got a hurricane-force headwinds for the currency at home as well. Indeed, speculative investors turned net short on the currency in June for the first time in 2 years, and the options market shows increased demand for wagers against the dollar, with a gauge of 1-year risk reversals for the Bloomberg Dollar Spot Index on a firmly bearish trajectory. Euro calls are trading at a premium to puts across tenors out to a year, a rare phenomenon that's occurred just 2 previous times, during March's turmoil and the financial crisis. Meanwhile, falling US government bond yields have also zapped currency hedging costs, knocking out another tailwind for the dollar. Until earlier this year, those costs were sky high, a product of US short rates being far above those of other countries, and made it unprofitable for many overseas investors to protect against dollar fluctuations. As a result, some foreign insurers and asset managers chose to buy US assets unhedged, buying dollars in the process. But that hedging expense has evaporated after the Fed slashed rates to near zero. Foreign investors can now buy dollar assets and hedge back into their local currencies at lower costs without any benefit for the greenback. That hedging aspect is underplayed, said Tim Groff, EMEA head of macro strategy at State Street Global Markets. It's a potential source of a long-term dollar downside. We know foreigners own loads of US equities and bonds, and they can now be hedged with very little cost. Reuters article dated August 20th, 2020. Sterling holds above $1.31 as dollar jumps after Fed minutes. Sterling touched a one-week low on Thursday but held above $1.31 as less dovish than expected minutes from the US Federal Reserve's latest policy meeting prompted bears to buy into the heavily shorted greenback. The pound traded at $1.31.27, up 0.2% on the day at 10:50 GMT, recovering from a session low of $1.30.62. Hit in early trade, but still far from Tuesday's 8-month high of $1.32.76. Against the euro, sterling fell 0.2% to 90.17 pence. The Fed minutes were vague, merely saying a number of committee members thought it would be helpful to make a revised statement on its policy strategy at some point, without providing details or timing. They also struck a cautious tone about the US economic recovery. That was enough to push risk assets, a category recently including sterling, in that the currency weakens when deteriorating market sentiment strengthens demand for the safe haven dollar, into a likely short-lived correction. Risk assets around the world are suffering a corrective 24 hours, said ING analysts. The catalyst has been a set of FOMC minutes that has failed to feed the rally by seemingly neither offering enough clarity on strategy, changes, nor fresh stimulus. The pound has gained more than 7% against the dollar in the past 3 months, but analysts have pointed out that this has more to do with the performance of the greenback. It is not a case of being over-optimistic on cable, as the coronavirus pandemic and Brexit worries mostly justify sterling depreciation, they say. 6-month risk reversals, the difference between put and call options, suggest money managers prefer selling the pound over buying it in the period which incorporates Britain's full exit from the European Union in December. The UK has reiterated many times it still hopes for a post-Brexit trade deal to be achieved in September, while both parties have given themselves a self-imposed deadline by October. In theory, there is still time until the end of the year to forge a deal, but with little obvious progress so far, the amount of time available looks limited, analysts say. Indeed, we've now seen the US dollar rise, and yet a strong case has been given for its inevitable fall. Stocks in Europe are currently down on average 1.5%, following a general 1% fall in Asia-Pacific markets overnight. And US markets are expected to follow suit in a downward direction, though their performance, in fairness, over the past month so far, has in fact seen gains of over 3%. So we shall see what actually happens to Wall Street in general in just a few hours' time. Now we can see a strong case for a weakening dollar over the short to medium term, but at the same time are cognizant that this could reverse should the COVID pandemic improve in the US and get worse in Europe and the rest of the world. Until a cure, or perhaps more likely a vaccine, is available, it really is anyone's guess as to when the severely damaging effects of its spread will cease to continue to wreak havoc on all of our economies. Needless to say, despite recent falls, we're still bullish precious metals moving forward. So one should perhaps use these pullbacks as an opportunity to acquire more, if you are light, in your holdings of those precious metals. Of course, as always, buying on the basis that you're taking the medium to longer term view into account. Thank you so much for listening. Do enter any comments you may have below and share your thoughts with us as to whether you feel the US dollar could actually stage a recovery, or, as some of the commentators mentioned today, that its value will continue to decline, even against the basket of other countries' currencies. Meanwhile, if you haven't subscribed to our channel, kindly do so, not forgetting to press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.